do one thing. Let's get back to the Morgan Stanley conference. Lata is right there with Chetan Ahya to find out what the macros could look like. Lata, over to you.
Okay, thank you very much. It was one angry President Trump, angry with the Chinese, angry with the Fed, angry with the world. And I think a person who can interpret what it means to the global economy and to India is with me, Chetan Ahya, head of global economics at Morgan Stanley. Thank you very much, Chetan, for joining us.
My pleasure to be here, Lata.
Well, you heard what President Trump has just said. What is the sense you're getting? Does it look like this tariff war get pulled back? And what is the read for the global economy?
Look, whether the tariff war gets pulled back, honestly, nobody knows. It's only the two presidents who know. But we think that some damage is done to the global cycle because we have now persisted for this for quite a long period. And secondly, if they do actually continue with escalation, we think that the risk of a global recession hitting us in 2020 is relatively high.
Oh, global recession. It's not just a slowdown that you are expecting. You're actually expecting a recession.
Well, we've had the slowdown. We were at 4% in first quarter of 2018 in terms of global growth. And we're already down to 3.2%. Global recession threshold is 2.5%. So if we continue with this escalation, we could be in 3-4 quarters down at that level of 2.5%, which would be qualifying us to be in recession at that point of time.
Yes, it's not a long way, 70 basis, if we can come down 1 percentage point in the past 1 year. But, this is a dynamic situation, and Jerome Powell has already indicated that he's ready for easing. How quickly are you expecting easing in the first place?
Well, I think it is important that the Fed appreciates the downside risk, and that is the big difference versus 2018 and now, that the Fed has already indicated that it is ready to ease. We saw Jay Powell indicating that a few days back. But look, the challenge with the policymakers is that this is, in their realm of framework, this is an external risk. It would be very difficult for the Fed to go aggressive in cutting rates before knowing what is the trade action that the president is taking. So unfortunately, policy response will be A, reactive. B, there's always a lag for policy action to flow into the economy. And so we think, unfortunately, we will hit a pocket of 5 to 6 months where you don't have the policy support and the trade tensions would have escalated further, creating that risk that we see global recession.
What are you expecting in the latest, the upcoming Fed policy itself?
Well,
can it ease as early as that?
It's very difficult, again, because they would not have known what happens on June 29th, which is when the two presidents are meeting, China and the US president. So it would be very difficult for the Fed to preempt that outcome and take the rates down. One thing that the Fed definitely looks at, independently of what trade policy is doing, is the overall financial conditions, which is basically what is happening to credit spreads, what is happening to dollar, what is happening to stock market prices. They calculate all of that into a composite financial conditions index. And in December, it had tightened by 75 basis points from September. So that's why they made that big pivot and change in their guidance. But right now, financial conditions haven't tightened enough for them to actually take the plunge and make the rate cut happen in June itself.
Okay. All right. Let me come to it from an emerging markets point of view. But before that, two indicators. The dollar index. It was at 98. Now it's come down to 96.5. This movement is usually pro-emerging markets. Emerging markets normally do well when the dollar is weak. So do you think we can get at least that kind of relief for emerging markets like India?
Well, not if we go into global recession. So the way you think about it, this is like kind of evolving in two stages. In the earliest, in the current stage where we are in, the market is saying that the US growth could be 1.5%, 2%. The Fed is responsive and Fed is cutting rates. That's kind of the sweet spot for emerging markets. It's similar to the typical late cycle situation in the US, what we had seen in 2006, second half of 2006 and 2007.
Yes.
But if you can't manage to keep the US growth in 1.5% to 2% range and we head towards recession, then unfortunately you will have a risk off and dollar rises and all the emerging markets assets will sell off.
But at the moment it looks like India feels that we are in a sweet spot. The dollar index is falling. Usually that means more expensive commodities, but not in this case because there is a global slowdown. So we have crude at 62. That's a great combo for us. So do you think India will be seen at least as a market that benefits Other emerging markets suffer when commodities fall. We gain. So would you at least say India has a slightly better chance?
No, Lata, I'll go back to the earlier discussion we had, is that if you expect that there is a deal on June 29th, then this sweet spot scenario comes into play because the Fed has already indicated that it's ready. Unlike 2018, where the Fed was saying it's far away from neutral and it's going to get into restrictive, it's right now saying that it will be easing. So you need that confidence that global economy is not going into recession. So if we continue into the current scenario, then it's great for India, but if we head into a recession, then unfortunately not.
Oh, no.
I do think that here in India, people underappreciate how much closely Indian business cycle is linked to the global cycle. So yeah, I mean, I don't think there was going to be, the way I describe this scenario is that there is no absolute winner in this trade war. You need to have really strong, definitely very different domestic fundamentals, which I don't think currently we have in India as well. So relative gainer, yes, India is a relative gainer, but not an absolute gainer.
No, I agree with you. I mean, Anuj and all of us are always discussing how we tend to get carried away by our growth and tend to get subsumed by the fall in our stock markets, but very often we are a derivative of the global economy and global markets. But let me come to India more specifically. I know I'm springing this suddenly on you. There is this Arvind Subramanian paper where he argues that when he looks at 17 indicators from 2001 to 2017, in the last 7 years, that is after the base year got changed, the Indian GDP is not gelling with these 17 indicators. We should be more like 4.5% growth for 2011 to 2017. Your first thoughts? Were you also confused with these GDP numbers?
No, I definitely think that there was some possibility of overstatement. So, you know, during my days when I was researching on India, the way I was looking at the data more closely was looking at the broad corporate revenue, aggregate corporate revenue, EBITDA growth and net profit growth. Yes, you get an estimate of nominal activity and not real, but that still gives you a better feel of what's going on in the economy rather than looking at the GDP statistics, which have got all kinds of issues, and the most important being the deflator.
Okay, yes, the deflator. But before, I mean, let's not get technical over there. I more wanted your view on this 5.8% GDP growth that we saw in the last quarter, Q4. We were not prepared for a 5 handle. A lot of people were forecasting closer to 6. Do you think this is a deeper growth problem than we are appreciating? And how long can this slowdown last, do you think?
I think it is a deeper growth problem. The two reasons for that. One is that global environment is not good. We looked at global trade numbers. Global trade volume is currently growing at close to 0% year on year, which is very different. On an average, global trade volume grows at around 3.5. At the peak in early 2018, we were actually at 5%. So global environment, which you have to look at from exports perspective for India, is not looking good. And you know, if you look at nominal industrial production in India versus nominal exports, it's very tightly linked. So the industrial cycle is very closely linked to what happens to global environment. And then, you know, our strategist Ridhan Desai and I had looked at what happens to India's corporate revenue and profit cycle. It's surprisingly very closely linked to nominal IP. So while we can look at the overall GDP growth, what matters for the corporate sector is what happens to the global business cycle. So I think that is one challenge for India. And the second thing is, I think the financial system is in some kind of stress. And we need to fix that to get that domestic demand going, even while the external environment may be bad. So I think because of that, there are some significant challenges ahead of India to get recovery going.
Well, a large part of our banks' NPA has been recognized and provided for. I mean, provisioning has gone steeply higher in the fourth quarter numbers. Yes, there is a non-bank finance problem which is now rearing its head along with the housing finance problem. But you think that can cause a longish slowdown? We thought it was over from IL&FS to now. But you think a lot more slowdown can be inflicted by the NBFC problems?
Yeah, I think so. I think the challenge would be to not get that kind of credit growth support that is needed for strong recovery. I think we can have a steady state, low growth environment that we are in right now. But to accelerate from here, we do need to fix that non-banking financial system, because it can have an impact on the overall financial system. Because, you know, there are two issues there. One is that the real estate sector has been in trouble for different reasons. and that's weighing on NBFCs. And the NBFCs itself has a funding liability, asset liability mismatch, and that needs to be fixed because that is then going to weigh on the other part of the banking system as well.
Okay, that's a very interesting conversation, and we will try and get you excerpts of that through the course of the show. The main point being Chetan Ahya of Morgan Stanley saying that if the trade tensions continue, then we could be headed for a global recession in FY20. But we'll do one thing, we'll take a quick break. On the other side of the break, we'll drill it down to the specifics. Our list of top 10 stocks are lined up.